Welcome to INFJ Investing Insights or III, a channel on personal finance and investing as viewed through the lens of an INFJ.
If you haven't already, please view the welcome video to find out what this channel is all about. What is the value of $1? Understanding the true value of $1 is very important when it comes to your personal finances. It makes you think twice before making any purchases that you may not really need and helps put your head into a saving mindset if financial independence is your goal. Financial independence is the point at which you could stop working and the profit from your investments is enough to cover all of your current expenses. It is a bare minimum requirement to even consider retirement. After all, there is always an opportunity cost, which is the loss of potential gains from other alternatives such as an investment. Let's explore the true value of $1 by discussing what you could do with that money. If you're like a lot of people and use it to buy a liability, then you lose that dollar and the value is zero, or you could lose more than $1 depending on what you buy. For example, if you buy a kitten from your neighbor for $1, then you lose the $1 and you'll end up losing even more money with the costs associated with taking care of the kitten, feeding, buying toys and accessories for the kitten, and paying veterinarian bills. If you put the money in a checking or savings account, then congratulations, you can subtract $25 off of your retirement nest egg requirement. This is based off of the 25x rule, which is derived from the 4% withdrawal rate rule in retirement. The 25x rule calculates your estimated nest egg requirement by multiplying your annual expenses by 25. For every dollar you save annually, you can subtract $25 from your nest egg requirement. For example, let's just say you decide to save $10, which is roughly the cost of a basic Netflix subscription, then you just save $10 each month for 12 months, which totals $120 per year. Using the 25x rule, multiply that $120 annual savings by 25 and you get $3,000. Your retirement nest egg requirement is now $3,000 less in this example. But, and this is a big but, the value of that dollar sitting in a savings or checking account will decrease in time due to an average inflation rate of about 2 to 3% per year. Interest rates from savings accounts tend to be less than 1% annually, so they will not be able to keep up with inflation, making the value of your $1 drop down to close to zero. So how do you get ahead of inflation to actually build wealth instead of losing it due to inflation constantly? By investing in higher yield investments. First of all, putting the money into a retirement account and maximizing that account would be the most advantageous move to reduce your tax burden. For example, putting an after-tax contribution into a Roth IRA means that any profits derived from that account won't be taxed again upon withdrawal. Putting a before-tax contribution into a 401k retirement account means that you will be taxed on the amount withdrawn in retirement, but at least the before-tax contribution will count as a deduction toward your taxable income for that year. Don't forget to assign a beneficiary for your retirement account so that it can be passed on to your family or loved ones, making this investment theoretically limitless if it continues to grow from an intergenerational wealth standpoint. Bonds are a type of investment that give a return that roughly matches inflation, thus essentially providing a more stabilizing effect on your investment portfolio. You might gain about 3% from bonds, but then you lose about 3% from inflation. Buying stocks tend to give the highest returns. The average return of the stock market over time is about 8 to 10%. Picking your own stocks may yield higher results, but you'd have to be a savvy and patient investor. Stocks, bonds, and cash are usually the elements that make up your retirement portfolio. Most people with retirement accounts forget or aren't aware of the fact that they are invested in the stock market if they have a retirement account such as a 401k or Roth IRA. The choices for choosing your investment portfolio through your job's 401k is usually confusing to most people, and for good reason. The choices presented usually don't describe very well what you are investing in at all, and it is exceedingly difficult for the average person to try to hunt down that information. The choices presented are usually mutual funds, which is a basket of stocks that diversify the number of companies you'll be owning. You may also have the option of choosing a portfolio based on your risk profile alone, or by your age, or with a target date fund which aims to try to automatically achieve a certain amount of money by a certain time period, but be aware of the expense costs associated with target date funds which could drain your profits. The option I chose was to convert my entire 401k into a self-directed brokerage account so that I could take matters into my own hands and pick my own stocks. Whenever my tax-advantaged account is maxed out, I then contribute my savings into a non-tax-advantaged, non-retirement account, brokerage account. This option isn't for everyone because it takes a rational and patient mind to take the do-it-yourself route. It also takes a lot of time with market research so that you can stay on top of your investments, but the rewards could be substantial. Stocks give the biggest boost to your profit returns through the magic of compounding. Reinvested dividends from a dividend stock could help snowball your wealth exponentially with time. A growth stock generally compounds your wealth by automatically reinvesting any profits into research, development, and growth of the company. Selling a stock after holding it for less than a year means you will pay a short-term capital gains tax, which is higher than paying a long-term capital gains tax, which occurs when you've sold a stock after holding it for more than a year. There is no capital gains tax if you sell the stock within a Roth IRA. When it comes to stocks as an investment, the most important key variable that affects the end profit the most is your time in the market. This bodes well for younger investors who start early. This is because the exponential effect of compounding works best when given a lot of time. The profit returns is theoretically limitless if you have a long runway in terms of time. If you start investing early at a young age, you have a longer runway. If you assign a beneficiary, then the wealth could be passed on to your loved ones, which passes the baton from your time to their time. If the companies you are invested in keep doing well and don't go bankrupt, then you have more time. If medicine advances into the genomics revolution and succeeds in increasing your human lifespan, then you will have more time in the market. Remember the mantra, it's not timing the market, but time in the market. To illustrate and appreciate the power of compounding, let's play with some compounding calculators to see what kind of results we can get. You should try it yourself using numbers from stocks of your choosing. Seriously, you should really try it. The online monthly dividend calculator above shows numbers for O stock, which is a real estate investment trust. It is a well-known stable dividend aristocrat, which means that it has consistently paid dividends every year to its investors for the last 25 years. Dividends are not guaranteed, but the fact that this stock has consistently paid dividends for years highly suggests that it is a stable company. I got the dividend growth rate from their website. Assuming you hold one share of the stock for 45 years, let's say from 20 to 65 years old, your initial roughly $71 investment would turn into roughly $26,529, an average annual return of 827%. The information is cut off above, but if you scroll up, the 10-year return is $118.98, the 20-year return is $266.59, the 30-year return is $941.46, the 40-year return is $6,758.67, and the 45-year return is $26,529.81. The numbers go up exponentially, but it does take time and patience. Instead of buying only one share for $71.06, let's say you purchased 100 shares for $7,106. If you scroll up, the 10-year return is $11,898.42, the 20-year return is $26,659.37, the 30-year return is $94,146.39, the 40-year return is $675,867.38, and the 45-year return is $2,652,980.53. An initial investment of $7,106 at 20 years old could end up being $2,652,980 by the time you're 65 if you keep reinvesting the dividends to take advantage of exponential compounding. So go ahead and try playing with the online dividend calculator. The one above is for monthly dividends. If you want to use one that compounds annually instead of monthly, I recommend using www.moneychimp.com or just Google Compound Calculator. So in summary, what is the value of $1? Anywhere from zero to theoretically infinite if you pass on your wealth intergenerationally and your companies never go bankrupt. Your stock portfolio could be managed and changed over time to adapt to the times. The best strategy is long-term investing because it lowers your risk and you shouldn't have to sell unless there is a fundamental change like a Blockbuster meets Netflix moment or if you really needed the money. Thank you so much for listening, and I hope you have grown wiser from listening to this. Don't forget to smash that like button, subscribe, and hit the notifications bell to hear more content.